At exactly 3:17 a.m. on February 9th, 2026, a phone rang inside the highest levels of the U.S. Treasury Department. The message was short, urgent, and instantly unsettling. Bloomberg was about to break a story involving China's banks and U.S. government debt. Within minutes, Asian markets reacted. Treasury yields moved, the dollar slipped. Financial networks began repeating one question like a warning siren. Was China turning America's debt into a weapon? But the truth isn't as simple as panic suggests. It's deeper, slower, and far more revealing. The headline sounded explosive. Chinese regulators had reportedly instructed major domestic banks to reduce exposure to U.S. Treasury securities. Not gradually, not in the coming months, immediately. The timing could not have been worse. Wall Street had just suffered its most brutal week since early 2025. Technology and software stocks, once the unstoppable engines of the AI boom, were collapsing. Investors were already nervous that what began as a correction was mutating into something more dangerous. So when the China news surfaced during active Asian trading hours, markets flinched hard. U.S. bond yields jumped. The dollar weakened. Equity futures softened. Anchors on financial television framed it as a possible economic attack. Was Beijing sending a warning? Was this the beginning of a coordinated move against the United States? Those fears spread fast because treasuries aren't T-just bonds. They are the foundation of the global financial system. The U.S. government debt market is the deepest pool of liquidity on Earth. If something disrupts that pool, everything from mortgages to retirement accounts can feel the ripple. But here's the problem. Most people misunderstand what this event actually represents. China has been reducing its treasury exposure for years. This wasn't a sudden dumping. It was a continuation of a long, deliberate shift, one that started more than a decade ago. Yet because the news arrived during peak market anxiety, it felt like a shockwave. That's what makes moments like this dangerous. Not because they always signal collapse, but because they arrive when investors are psychologically vulnerable. And in February 2026, vulnerability was everywhere. Stock valuations were stretched. Earnings expectations were high. Economic data was beginning to soften. The Federal Reserve was trapped between inflation pressures and slowing growth. In that environment, even a small spark can feel like a firestorm. The real issue isn't whether China is launching an economic war. The real issue is that global markets are entering a new phase. One where money is no longer free, volatility is no longer rare, and the financial world is being forced to rebalance after years of excess. That is the storm forming behind the headlines. So what was China really doing? And why did this guidance matter so much more than the words themselves? Because here's the truth. China cannot simply wake up one morning and dump hundreds of billions of dollars in U.S. treasuries without destroying itself in the process. The idea of Beijing launching an overnight financial strike makes for dramatic headlines, but it collapses the moment you apply basic logic. If China tried to sell aggressively, treasury prices would drop, yields would surge, and the value of China's remaining holdings would instantly shrink. They would be selling into a falling market, locking in massive losses. It would be like burning your own savings just to make a political point. And even if China wanted to exit completely, where would they go? There is no alternative asset deep enough to absorb that kind of money. European bond markets are fragmented and far less liquid. Japan's debt burden is even heavier than America's. Gold cannot handle $600 billion in sudden demand without exploding in price. Bitcoin is too volatile and too small to function as a true reserve replacement. That's why this isn't really about China attacking the U.S. Treasury market. This is about positioning. China has been reducing its Treasury exposure for more than a decade. Their holdings peaked back in 2013 and have steadily declined ever since. February 9th wasn't the start of something new. It was simply the moment the world noticed the trend at the worst possible time. Because Wall Street was already bleeding. Tech and software stocks, the stars of the AI boom, were collapsing. Investors were suddenly questioning whether trillions in AI spending would ever translate into real profits. Job market data was softening. Volatility was rising. Confidence was cracking. So when the Bloomberg leak hit during peak market stress, it felt like a shockwave. But the real story isn't a sudden Chinese weapon. The real story is that the global financial system is slowly rebalancing. Central banks are buying gold. Reserve managers are diversifying away from the dollar. Markets are adjusting to higher interest rates after years of easy money. This isn't collapse, it's transition. And the question isn't whether China is starting a war. The question is whether investors are ready for what comes next. To understand what happened on February 9th, 2026, you have to step back and see the larger pattern. Because the Bloomberg headline made it sound like China suddenly flipped a switch. But the reality is far more gradual and far more strategic. China's relationship with U.S. Treasury debt has been changing for over a decade. Their holdings didn't drop overnight. They peaked back in 2013 when China held more than $1.3 trillion in U.S. government bonds. At that time, China was the single largest foreign creditor of the United States. sitting at the center of the global reserve system. But since that peak, the trajectory has been steady and unmistakable. Year after year, China's Treasury position has slowly declined. By late 2025, it had fallen below $700 billion, the lowest level since the aftermath of the 2008 debt financial crisis. That's not a sudden attack. That's long-term diversification. So when regulators reportedly advised Chinese commercial banks not to build new, large Treasury positions, it wasn't a radical departure. It was another step in a process that has been unfolding quietly for years. What made it feel explosive wasn't the action itself. It was the timing. Because the guidance surfaced at a moment when Wall Street was already dangerously unstable, the first week of February 2026 had delivered one of the sharpest sell-offs in technology stocks since the pandemic era. Software companies that had been the heroes of the AI boom were suddenly collapsing under their own weight. Major tech ETFs fell double digits in a matter of days. Giants like Microsoft, Salesforce, Adobe, Workday, and Atlassian were hitting fresh lows. Investors who had spent 2 years believing AI would justify limitless valuations were suddenly forced to confront an uncomfortable question. When does the spending turn into profit? The AI revolution has not been cheap. Companies announced staggering infrastructure investments, hundreds of billions of dollars for data centers, GPUs, cloud expansion, and research. Wall Street initially celebrated these announcements as proof of dominance. But eventually, enthusiasm turned into skepticism. Because pouring money into the future is easy, turning that money into earnings is harder. Valuations across the tech sector had been pricing in perfection. Growth stocks were trading at extreme multiples based on future expectations. The moment investors began doubting those expectations, the sell-off became brutal. At the same time, a powerful sector rotation was underway. Capital began flowing out of speculative growth and into real economy companies, industrials, energy, financials, consumer staples, businesses that generate steady cash flow, not just promises of disruption. This rotation was healthy in the long run. It reduced the concentration risk that had built up in a handful of mega-cap tech names. But in the short run, it felt violent because leadership was breaking down. And when leadership breaks, fear spreads. Then the economic data added another layer of tension. Job openings declined sharply, falling closer to levels last seen during the pandemic recovery. Layoff announcements surged. Professional services, retail, finance, sectors that had appeared resilient began showing cracks. The narrative shifted rapidly. A soft landing suddenly looked less certain. Maybe growth was slowing faster than expected. Maybe the Federal Reserve's rate hikes were finally biting. And if the economy slows, earnings don't just miss, they collapse. That was the psychological environment when China's Treasury guidance leaked. But here's what most people missed. China reducing Treasury exposure is not unique. Other countries have been doing the same. Several major emerging markets have trimmed their U.S. debt holdings. The BRICS bloc has been quietly diversifying. This is part of a broader shift in reserve strategy, not a single dramatic move. Yet, despite official selling, total foreign ownership of U.S. Treasuries has actually increased. That's the critical detail. Private buyers, global pension funds, insurance firms, hedge funds, asset managers have stepped in. The Treasury market absorbed China's decline without breaking. That tells you something important. The U.S. bond market remains the deepest and most liquid financial market on Earth. Even a major holder like China cannot easily destabilize it. And that's why the weaponization narrative is overstated. China cannot dump treasuries aggressively without hurting itself. Selling would spike yields, crash bond prices, and destroy the value of China's remaining reserves. It would also weaken the dollar, making Chinese exports less competitive at a time when China ACO's domestic economy is already struggling with deflationary pressure. More importantly, China has nowhere else to park that money. No alternative reserve asset is large enough. Europe's bond markets are fragmented. Japan's debt levels are extreme. Gold cannot absorb hundreds of billions quickly without sending prices into the stratosphere. Crypto markets are far too volatile to serve as a stable reserve. So instead of an attack, what we're seeing is risk management. China is slowly diversifying into other assets, especially gold. Central banks worldwide have been accumulating gold at record pace. This is de-dollarization in slow motion, not a collapse of the dollar, but a gradual rebalancing. The dollar's share of global reserves has declined over decades, not weeks. The system is adjusting, not imploding. Meanwhile, the bigger risk facing investors in February 2026 is not China, it's valuation. The S&P 500 is trading at historically elevated forward earnings multiples. Levels like these have only been sustained during bubble-like periods. Midterm election years also carry higher correction probabilities. Volatility is rising. Credit spreads are widening. Sophisticated investors are responding accordingly. They are trimming exposure to unprofitable growth stocks. They are rotating toward value and defensive sectors. They are building cash positions to deploy when fear creates genuine bargains. and they are watching credit markets closely, because credit stress always precedes equity crises. This is the true story of February 2026. China's Treasury move is not a financial missile. It's a signal weight in a larger transition. The global financial system is rebalancing after years of stimulus, zero rates, and speculative excess. Higher interest rates are forcing repricing. Tech was hit first because tech is most sensitive to rates. Other sectors will adjust next. The question is not whether China is attacking America. The question is whether corporate earnings can grow fast enough to justify the prices investors are still paying. That is the foundation. Everything else is noise. Here's the real truth behind the February 9th headline, and it's far more important than the panic suggests. China is not weaponizing U.S. Treasuries. China is managing risk. That distinction changes everything. The Bloomberg leak made it sound like Beijing was preparing an economic strike, as if China could simply dump hundreds of billions in American debt and bring Washington to its knees. But that story collapses the moment you look at the math, the incentives, and the structure of global finance. If China tried to sell treasuries aggressively, yields would spike and bond prices would fall. That would raise borrowing costs for the U.S., yes. But it would also instantly destroy the value of China's remaining holdings. They would be selling into a crashing market, locking in enormous losses. It would be financial self-sabotage. And even if China wanted to exit completely, the next question is unavoidable. Where would they put the money? There is no alternative reserve market deep enough. European sovereign bond markets are fragmented and less liquid. Japan's debt burden is even heavier than America's. Gold cannot absorb hundreds of billions in sudden demand without exploding in price. Crypto markets are far too volatile and too small to function as a true reserve replacement. The reality is brutal. Treasuries remain the only pool large enough for reserves of that scale. That's why China's strategy has never been about dumping everything overnight. It has been about gradual diversification over years, reducing concentration risk while avoiding disruption. And this isn't unique to China. Other major countries have been trimming Treasury exposure as well. Emerging markets, Gulf states, and BRICS nations have all been quietly adjusting their reserve allocations. The shift is real, but it is slow. This is not collapse. This is rebalancing. At the same time, here's the part almost nobody talks about. Total foreign ownership of U.S. Treasuries has actually risen. Even as official holders reduce positions, private foreign investors have stepped in. Pension funds, insurance companies, asset managers. The Treasury market has absorbed this selling without breaking. That is not a sign of weakness. It is proof of strength. The U.S. bond market remains the deepest, most liquid financial market on Earth. It is still the ultimate safe haven asset, even as major players diversify around the edges. So what was February 9th really about? It wasn't a weapon. It was a signal. A reminder that China has leverage, options, and influence, even if it cannot afford to use them recklessly. By allowing the guidance to leak during a week of maximum market vulnerability, Beijing achieved something subtle. It created optics of pressure without triggering actual crisis. Soft power, not hard action. But here is what investors should actually be worried about, because the real danger isn't China. The real danger is valuation. Markets in early 2026 are stretched. AI optimism inflated prices. Tech stocks were priced for perfection. Now that perfection is being questioned, earnings must justify spending. Growth must justify multiples. And if earnings disappoint, the downside is not a gentle correction. It becomes a deeper repricing. That's why volatility is rising. That's why credit spreads matter. That's why sophisticated investors are rotating into quality, raising cash, and preparing for opportunity during fear. China's Treasury move is a footnote in a much bigger story. The real story is that the post-2020 era of easy money is over. Liquidity is tighter. Interest rates are normal again. Speculative excess is being unwound. This is not the end of the system. It is the return of reality. Long term is simple. Earnings. And the only signal that matters, low, watch the earnings. Everything else is noise. So what should investors actually do right now? First, expect volatility. 2026 is not the calm market of the early decade. Corrections of 10 to 20% are normal after massive run-ups. Second, check your concentration. If your portfolio is overloaded with high growth, unprofitable tech, rebalance into quality companies with real cash flow. Third, build flexibility. Cash isn't trash when volatility rises. Having reserves allows you to buy when fear peaks. Fourth, watch credit markets. Equity headlines are loud, but credit stress is the true early warning system. And finally, ignore panic narratives. China isn't crashing America overnight. This is slow repositioning inside a global rebalancing cycle. The real question is earnings. That's the foundation. Everything else is theater. And that brings us back to the phone call at 3:17 a.m. It wasn't the beginning of a financial war. It was a reminder that the world is shifting quietly, steadily, strategically. China is reducing exposure. Central banks are buying gold. Wall Street is rotating. Valuations are stretched. Volatility is rising. All of these are pieces of the same puzzle. The post-2020 era of easy money is over. Now comes the adjustment. The next major opportunity won't appear during comfort. It will appear during fear. And the investors who understand the difference between noise and signal, between headlines and fundamentals, will be the ones positioned to benefit. Because China isn't the story. The market isn't even the story. The story is whether earnings, growth, and reality can catch up to the prices investors have been paying. Watch the earnings. Everything else will follow.